Hi everybody, this is Axel from freemarketsilver.com. You clicked on probably the education link, which is how you got to us. And also we've got our YouTube channel, which is Free Market Silver at YouTube. I'm on the line with David Morgan. David Morgan is from silver-investor.com. He's the author of the Morgan Report. If you don't subscribe to it, I'd recommend that you probably look into it. It's a great report to have. And he touches on probably more than anybody else out there that I've seen in terms of a report, and it's fairly inexpensive. So if you have time, go to silver-investor.com and take a look at his report. So without any further delays, we'll get right into this because I like to keep these videos short if I can, and we'll talk to the man himself. So David Morgan, welcome.
Well, thank you, Axel. It's nice to be with you.
I've got a this is actually a really interesting day in the market to do an interview. In fact, let me pull this up. Lots of news. Gold up almost 20 bucks on the afternoon. Silver $1.85. In fact, everything is up. The Dow up 363 points, and then of course the dollar getting its butt handed to it. It looks like at off $1.35. What are your thoughts overall? Is this do you think this is possibly related to the European crisis and the so-called sovereign debt issue that they've come up with a solution? Is it really solved? And if it is, what are the implications for the U.S.?
Well, the markets definitely are reacting to this quote-unquote solution. Is it really solved? No. You've got a situation where the Eurozone has admitted that the Greek debt is unpayable. So basically they've said it's worth about 50%, or it's worth about half as much as face value. That's probably a good rough number. In some instances it may be worse than that, but we'll take it at half price sale. The market already acknowledged that. If you look at what the interest rates were on that debt, was astronomical. And anyone that knows finance knows when interest rates go higher, bond values go lower. So the market had already priced this in pretty much. Now the Eurozone has acknowledged it. Greece is going along with it. They're actually asking China and Japan to come on board. Everyone's kind of in the game, so to speak, globally, to put quote-unquote money into the system, and happy days are here again. I'm doubtful because there is no way really to pay back this debt, and they've leveraged it again. So the problem are two things. One, there's never been a fiat system in the history of mankind that's ever gone indefinitely. They've all failed. Secondly, the problem is debt, and so adding to the debt is not really going to help it in the long run. And the market feels good today, and it may for a few more months, but I don't see it as a real solution.
So what you're saying essentially is you think that the real possibility is that Greece and other countries, Greece and Italy possibly right behind them, could be in the exact same spot in a matter of months.
Well, perhaps not Greece. I mean, basically their bonds have been kind of almost mark to market, but you've got Italy, you've got Spain, you've got other issues. The bottom line is this: there's more money owed that can be paid back. And people have a misconception that government is an entity that is all powerful all by itself. But if you analyze it succinctly, government is nothing more than a collective of the people. And if the people owe $50,000 per person, as an example, and their total net worth is $25,000, obviously it's impossible to pay back the debt. And that is government debt. It's the debt of the collective body of all the citizens. And that's where we're at. That might not be the exact numbers, but the idea is extremely clear. That's how it works. And until people get that idea, then they're living in a fiction. They're living in a belief system that this thing can go on, things will straighten out, and we'll grow our way out of it, and all these other little nomenclatures that you hear across the mainstream financial press, but they're inaccurate. They don't exist. You cannot pay back $5 if all you have is $2. And that's the situation. So certainly on a short-term basis, everyone's happy and it looks like things will be good. But in the longer term, they cannot be.
So this is like peeing your pants to warm your butt.
Something like that. I wouldn't have said it, but certainly that's a pretty good analogy.
Real quickly, touch on the gold bubble / currency bubble factor myth. This is a question that I get a lot. Actually, is is gold a bubble? Is it going to come back down? Are we going to see $900 gold again? These are questions that I get all the time. But this would be something to be interesting to have you weigh in on. What are your thoughts?
Sure. I've said actually during the silver quote unquote bubble that it was a precursor. It was a little bit of a taste of what the real bubble is going to look like. Silver, accelerated after QE2 was announced, and it went roughly from 26 to 50. So it almost doubled under the QE2 announcement. And then, of course, it's fallen off now, as we all know. Gold moved from about 1550 all the way to 1900, and there again, you might have a little bit of a foretaste of what gold's really going to do, but this is far from a bubble. I was interviewed on CNBC, and I remember we spoke about that afterwards, and I was asked, about the gold bubble, and I corrected the interviewer, and I said, it's not a gold bubble. Gold doesn't change. An ounce of gold is the same anywhere and always. What changes is the debt bubble. It's really a debt bubble, and gold is reflecting that problem in its price mechanism. And they cut me off. Well, maybe they didn't cut me off. Unfortunately, technical problems ensued, and due to technical difficulties, I was no longer on the show. I'm not sure I'll be invited back. I probably will. I don't know. But that's the idea. The debt is the problem. Gold is only monitoring or a barometer of that problem. Going a bit further, you haven't asked, but I think you implied in the question, is this the end of gold? And the answer is no, of course not. The fundamentals for silver and gold investing have never been stronger. Having said that, because there's so much gleefulness in the market and happy days are here again and things are going to be wonderful again, you're probably going to see more consolidation time-wise than some people think. I could be wrong here. Based on today's action in the gold and silver markets, certainly looks like, they're ripping and raring to go, and we're going to take out the old highs here pretty soon. I am a bit suspect. I think this is an overreaction by the markets. Things will settle down. I still think we have some rebuilding to do in both the gold and silver markets before we start making, new highs in both those markets, but that will take place.
You interested in calling a bottom?
Never, but I will. I get asked all the time. I'm on record as saying I think the 26 or 26 and change intraday low that we saw in silver is probably it for silver.
Mm-hmm.
I wouldn't rule out that it could go lower. There was a good article written by Chris Poplava, which is those that follow my work closely know I'm interviewed on Financial Sense NewsHour from time to time, and one of James Poplava's sons wrote a great article on silver and how this looks similar to 2008. And he made a case it could go down into the 20s. I don't know. He doesn't know. I doubt it. I think, again, that 26 is probably as low as it's going to get. Gold, that's possible to get under 1,600. But I'm on record already as saying anything under $30 for silver in U.S. dollar terms, buying for cash and holding for 2 to 3 years is an excellent buy. That doesn't mean that we won't see it again, far below 30, no one knows. But I think 30 is pretty good. Basically, you had that opportunity just a few times here.
Yeah.
There haven't been a lot of days you could buy silver under 30, and here we are at 34, 35 right now.
Yeah, something like that.
And gold, we're looking at, I'd say anything under a $1,600 level of the long-term perspective. The long-term these days is 2 to 3 years. So I think either one of those benchmarks for physical buying of the metals is good. If it got under 1,600, for example, for gold, I wouldn't put all your funds in at that time, but I'd certainly accumulate and plan to buy over the next 2 to 3 months. And I think that's a great strategy because, again, the fundamentals for these two metals have never been stronger.
So you're not to, and I know I try not to get into too deep into politics, though it's hard to avoid it. So no, I'm not going to ask you who you're voting for or anything like that. But as far as what are your thoughts on the seeming kamikaze mission of some of the central banks? They're almost in a race to the bottom in terms of devaluation, because it isn't just dollars there's other currencies out there as well and stuff. Your thoughts on just on that and stuff. And I'm that's kind of a loaded question, I understand, but just your generic thoughts on that.
Well, Jim Dines is the one deserves credit for the race to the bottom, because those are his exact words.
Mm.
And all these currencies are trying to soften against other currencies for an export advantage. In other words, they want demand for their products to take place, and the way you do that is you sell your goods or services cheaper than everybody else, and that increases demand. So what you really have is this anti-strong currency policy across the globe. And all this does is just drive the system further into the hole, because you really want stability. You want confidence and trust in the system. And all those things are going away rapidly. And that's why you're going to see the markets for gold and silver increase, because that's the one asset class that's within the monetary system, particularly gold, that is valued as a standalone, default-free, confidence-building asset.
Do I have that right then? I've always you hear about these things when you hear politicians talk about or not just necessarily politicians, but politicians, bankers, etc. They'll talk about, or these policy wonks, they'll talk about the exports. They'll say, well, but if we have a weaker dollar, it's great for the exports. And look, see, our GDP is soaring. But well, of course it's soaring. The money is cheaper, so of course you have more dollars in the system. So yeah, your exports are great. Your GDP numbers are up. Let's say you're up 8% annual growth, but that includes all government largesse. It includes everything. So if I'm hearing you right, what he's saying is that when you're basically printing money, for lack of a better term, but that's very blunt, that's what it is, you're able to get a better exchange on your imports.
Let me simplify it somewhat. I think I'll put it in terms.
I may have heard that wrong. So
well, let's look at it slightly different. Let's look at a basic capital structure where everyone can relate to it. Okay, so you're going to start a business, and you don't have the money to start the business. You've saved, so you have some savings, but you need more capital than that to start your business. So you go to the bank, and the bank looks at your business plan and says, yeah, it's approved, and we're going to loan you money. So you borrow money from the bank, and for every dollar that you borrow over the next 2 years, you're able to increase your profits by a substantial amount and eventually pay back the loan. So that's a proper use of debt. In other words, you borrow a dollar, and over like a 3 to 5 year period, each dollar that you borrowed produced, let's say, $4 in profit. Okay? So you're increasing on your little business a GDP, or your gross domestic product, or your product profitability substantially. So that's a proper use of using credit or debt, either way you want to think about it. Well, in the United States, if you go back several decades, you could borrow like $2 to get $1 GDP growth. So now it'd be like you going to the bank for your business and saying, yeah, I need to borrow, and the bank says, okay. So for every dollar that you borrow, you're only losing $1 in profits over time. And then a few years later, you go back to the bank, because now it takes you have to borrow $5 to increase your GDP. This is the United States now. Borrow $5 to get $1 in GDP growth. So you see where I'm going with this. Anything that has a lot of it has less value. So if you have a lot of, you had a huge bumper corn crop, as an example, the commodities markets are going to punish the corn price because there's, in that year, too much of it. Might be a bad example, but that's the idea. You got a lot of something, the price goes down, not up. Well, there's so many dollars, so you're stimulating the economy, but it's not going the right direction. In other words, if it takes $5, it's way above that now, by the way. But just going back a few years, $5 of stimulus only produced $1 in GDP growth. So we're at a point, if you can really think this through, that they can throw all the funny money at this that they want, and it's not having much of an effect. Yet today isn't a good day in the market as far as making that very succinct. People are going to look and see the Dow's up 300 points, and all markets moving together. Gold's up, silver's up, everything looks wonderful again. But this is one day, and you certainly cannot judge an economy based on one day in the market.